Hello everyone. So in today's video we're going to understand what are options. That is, we're going to understand the concept of call and put options. Now this is probably the most technical video when it comes to financial markets, but you don't have to worry because I'm going to be using a lot of examples and I'm going to simplify this topic as it's going to be for a layman. Also, if it gets too technical, what I would suggest is that please pause the video and go through every word which is written on that page, because I have pretty much written what I'm going to be speaking, so you can grasp whatever is the concept I'm trying to explain. But don't worry, don't think too much, and let's go step by step and understand the idea of options. So basically, what is an option? So option is firstly a derivative contract. So like how you have forward and futures, option is also a derivative contract. Now the way option differs is that an option is a type of a derivative contract which gives the buyer of that option the right. So that person who's bought the option contract has the right and not an obligation. That is, he has a choice if he wants to either buy or sell a particular asset in the future at a specified price as is mentioned in the contract and within a time duration as is specified in the contract. So basically, option is a derivative, and anyone who's buying the options derivative, depending on the type of the option derivative he's buying, he has the right to buy or sell the asset which is mentioned in the contract, in the derivative contract, at a agreed price and within the time duration as is specified in the contract. So this is what an option is, and once we use examples you'll understand it even more clearly. So options are like your other derivatives such as futures, traded on stock exchanges such as the National Stock Exchange or the Bombay Stock Exchange. Now in the future there's going to be a dedicated video where we also going to talk about the different stock exchanges as well as SEBI and its functions. So stay tuned for those videos as well. So now let's get back and understand that if you talk about options, there are two types of options which exist. So you have the call option and then you have the put option, and now we're going to understand both these options. So a call option is basically a type of option which gives the buyer of that option the right and not the obligation. That is, it's a type of option which gives the buyer the choice if he wants to buy a particular asset in the future at a pre-agreed price. So anyone who buys a call option as a contract, he has the right if he wants to buy a particular asset in the future and at a price as is specified in the contract. Now a reason why someone will want to buy a call option is that if he feels that the price of a particular asset is going to rise in the future. So let's say if someone feels that a share price of a company is going to rise in the future, so he can sign a contract and agree on a specified price, and this way he'll get to buy that particular share at a pre-agreed price, and if the price is way higher than the pre-agreed price, he can profit on that difference. So let's take this further and use an example. Let's say there is a company called XYZ and currently the shares of that company are trading for 100 rupees per share. Now let's say there is an investor who believes that this 100 rupees per share price for this company XYZ is too low and it's going to rise in the future. Now this person has two options. First is that because he feels that the prices are going to rise in the future, he can make a capital gain by buying the stock of the company. But this is going to cost a lot more money because you'll have to pay for every share you buying. So if you're buying 100 shares, so you'll have to pay 100 into given 100 price right now, you'll have to pay 10,000 rupees. The other option is that you can buy a call option, and the reason why this is tempting for a lot of investors is that because out here you'll be spending much lesser money. So let's understand this even further. Let's say you are buying this call option and there's someone who's selling this call option contract to you, and the contract details between both of you is that you're going to, if you want, buy the stock of this company XYZ in the future, say within 3 months duration, and you agreeing to buy these shares at a price of 105 within this 3-month duration time. And for every share, for having the right to buy every share within 3 months, you paying a premium, or you paying 5 rupees per share to the seller of this call option, because he's giving you that right to buy the share. And let's say you are agreeing that if you want, you will buy 100 shares in the next 3 months if you desire. So you'll buy 100 shares together in the next 3 months if you want. So the total cost you are incurring out here, if you're buying shares, 100 shares, you're paying 10,000 rupees. But out here you have the option to, in a way, invest in these shares by merely paying 5 rupees per share into 100 shares. That is, merely by paying 500 rupees premium, you are getting the option to buy these shares in the future. Now let's say you've signed this contract, and within 3 months, 2 key scenarios are possible. Let's say the first scenario is that the stock price of this company XYZ rises to 120 rupees. Now this stock priced at 120 is clearly more than the price at which you've agreed to buy, which is 105 rupees. So what you can do out here is that you can clearly buy these shares at 105 rupees from the person who sold you this call option, and then you can sell this share in the market for 120 rupees. So this way you're going to be making a profit of 15 rupees by selling the share in the market for 120. However, you have also paid a premium of 5 rupees for every share for having the option to buy these shares in the future. So your net profit becomes 10 rupees per share. So all in all, you'll be making a profit of 10 rupees per share, and for total 100 shares, your total profit is going to be 1000 rupees. So by investing 500 rupees out here, you're making a profit of 1000 rupees. Whereas in the earlier scenario, you would have had to invest 10,000 rupees. So this is the benefit you are getting by buying the call option out here. Now let's say in the future, the stock price of this company XYZ drops to 90 rupees. Now in this case, this price of 90, the market price is way lesser than the price you agreed to buy, which is 105 from this seller of call option. So in this case, buying the share for 105 makes no sense, because even if you want to buy, you can buy it in the market for 90 rupees. So what you're going to do is that you're going to let your call option, that is the contract which is giving you the right to buy, expire. That is, you're not going to exercise your right of call option. So this contract is going to expire eventually after 3 months, and you're going to be incurring a total loss of only 500 rupees, which is the premium you've paid out here. So if you talk about the risk and reward for the buyer of the call option and the seller of the call option, so buyer of call option, so the risk for the buyer of call option is that if he does not exercise the right to buy those assets, so he'll be losing the amount he's paid as premium. So basically, as we talked right now, if you bought the call option and you do not exercise that right, so in this case you would have lost 500 rupees. But the potential reward you can earn is mathematically unlimited, and by this we mean that if the share price is say in lakhs or even more, and because you're buying that share for only 105, you will be making the difference between that stated price and 105, which can be unlimited depending on how high it is. However, as a seller, if you talk about, while you're receiving the premium upfront, that is the maximum gain you can have. So that is the maximum gain you can have, because there is a very big risk, which is that if the price rises in the future, then you will be compelled to sell those shares for 105. But if you hadn't actually sold that call option, then you could have sold that share in the market for a much higher price. So you have the risk of not being able to sell in the market for a much higher price. So that is the risk you have. So this was the broad concept of call option. Now let us understand what is put option. So put option is another type of option, but out here the buyer of the put option has the right and not the obligation. That is, the buyer of the put option has a choice if he wants to sell a particular asset in the future at a pre-agreed price, which is called the strike price, and within a specified duration as is mentioned in the contract. So a put option is giving you the right, if you want, to sell a asset in the future at a pre-agreed price, while the call option was giving you the right to buy that asset at a pre-agreed price in the future. Now let's say there is a company which is called ABC and its shares are currently in the market trading for 200 rupees per share. Now let's say in the future you have a belief that the stock price of this company is going to crash and its shares are going to be valued at a much lesser value. So you can actually benefit from this scenario despite the share price falling, and you can do that by buying a put option. So let's say you buy a put option, and so you're the buyer of the put option and there's someone who's selling you this put option contract, and both of you sign a contract whose details are that you're going to sell the shares of company ABC in the future within 3 months window. And let's say you are agreeing that you'll sell the shares for 190 rupees per share, and to get this option to sell the share, let's say you're paying a premium of 10 rupees per share, and the total number of shares you're committing that you will have the right to sell is 100. So the total cost or the total premium you're going to be incurring is going to be 10 per share into 100, which is 1000 rupees. So that's the total premium you're going to incur. Now let's say after you've signed this contract and in the 3-month window, there are two scenarios which are possible. Let's say the stock price of this company ABC drops to 150 rupees. Now this price of 150 is much lesser than the price at which you've agreed to sell the shares to the seller of this put option, which is 190 rupees. So what you can do in this scenario is that you can buy these shares in the open market for 150 and then you can sell them to this seller of put option for 190 rupees. So basically you'll be making a profit of 40 per share. Now because you've paid an upfront premium to the seller of this put option of 10 rupees per share, so net you're going to be making a profit of 40 minus 10, which is 30 rupees per share. So in total you'll be making a profit of 3000 rupees by selling these 100 shares, and you have made this profit of 3000 by investing 1000 rupees upfront. So if the stock prices crash, you can make a profit if you bought a put option, which is an option which is giving you a right to sell in the future. Now let's say the second scenario is that the stock price rises to 220 rupees. Now in this case, because you agreed to sell the share for 190 rupees, it makes no sense to you to sell the share for 190 rupees when you can clearly sell it in the market for 220 rupees. So what you're going to do is that you're going to not exercise your right to sell and you're going to let your contract expire. So after 3 months your contract is going to expire and your total loss is going to be 1000 rupees, which is the premium you've paid. So you paid 10 rupees per share and you had a contract for 100 shares, so your total losses are going to be 1000 rupees. So if you talk about in this scenario, in case of put option, what are the risks and reward for buyers and sellers? So as a buyer, if you talk about, your maximum risk is 1000 rupees. That is, if the share price is a lot higher, so you will not sell the share to someone who sold you this put option and you will incur a maximum loss of 1000 rupees, which is the premium you've paid upfront. Whereas your maximum reward out here can be 18,000 rupees or 180 per share, because you've agreed to sell the share for 190 rupees and now let's say the share price actually drops to 0 and you can buy the share for pretty much say 0, mathematically speaking. So you are selling for 190 and you've paid a premium of 10, So you are making a profit of 180 because you buying these shares for almost zero. So you can have pretty much such a massive profit as a buyer. But as a seller, if you talk about, the maximum risk becomes 18,000 rupees. That is, even if the share price drops to zero, the seller will have to buy the share for 180 because he is committed to buy the share. Sorry, he'll have to buy the share for 190 because he's agreed to buy the share for 190 in the future. And because he's gotten already a premium of 1000 rupees, so his total loss becomes 18,000. That is 19,000 at which he's going to buy the shares if he has to, and 1000 which is the premium he has received. But as a seller, the maximum reward you can earn is 1000 rupees, which is the premium you've received upfront. So this was the broad concept of put options. So now we've discussed what are options, what are put and call options. So I hope you like this video, and after watching this video these concepts are clear. In case if they aren't, what I would suggest is that do pause the video wherever things become a bit hazy and re-watch it, and I'm sure these examples are going to help simplify this topic. I hope you like this video. If you did, follow the channel for more concepts in regards to UPSC economics. Thank you so much for watching.